The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
An ugly end to a turbulent week. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Katie Greifeld.
And I'm David Gura. We are kicking you off to the closing bell here in the United States. Let's look a bit at that turbulence, the ugliness of this week. Once again, a lot of red on the screen as we come to the end of Friday's day of trade. The Nasdaq 100 in correction territory today. And we look at the S&P 500. Hasn't been this bad in 4 years' time, highlighting the difficulties placed on the market by both all of the geopolitical uncertainty, the widening war in the Middle East, of course, and still those latent concerns about AI, artificial intelligence. I'm looking at Brent crude here, up once again today, $112 a barrel. This is a story, I think, occupying everybody in the market, how high these numbers are going to go and how long they're going to last. Finally, I put the VIX up here. We see it at 31, far from quiescent, as our friend and colleague Tom Keene would say. Is again, this agitation caused by the turbulence in the Middle East really transmitting itself to the way the traders are looking at this market, Katie.
Absolutely. Well, I have a not so fun fact for you, David, and that is that stocks have fallen every Thursday and Friday this month, and today that trend continues. And while the Nasdaq is making all the headlines as it falls into correction territory, the S&P 500 on course for its longest streak of weekly losses since 2022. You now have traders grappling with the prospect of longer than anticipated war in Iran, fueling today's negative sentiment. Oil traders in particular seem to be pricing in an escalation of the war, with Brent prices topping $110 per barrel, like David mentioned. And further escalation from Iran could only drive those prices even higher. And those climbing gasoline prices, they're a huge factor in consumer sentiment, falling to a 3-month low. Year-end inflation expectations also jumped by the biggest since April of last year. But there is a silver lining, and that is that longer-term inflation expectations are easing. So it will eventually get better, at least if you ask the average consumer right now, David, but some pain expected in the short term.
You mentioned April. We are poised to enter April, of course, the cruelest month, to use Eliotic terms. And we look at the prediction markets to see what traders are thinking about what President Trump has said about when these operations in the Middle East are going to end. We heard more from the Secretary of State about that today. He said we're measuring it in weeks, not in months. But you look at Polymarket and see 48% of those who are participating in that predict that these operations will be wrapped up by the end of April. Again, I think of where we were yesterday, the president announcing this pause on that deadline for when the U.S. and Israel might strike power plants in Iran. Indeed, Katie, over the course of today, we saw Israel just doing just that, striking a power plant in Iran.
Well, April, as you mentioned, mixing memory and desire. Let's kick things off with Jim Caron. He is CIO of the Portfolio Solutions Group over at Morgan Stanley Investment Management. Jim, great to have you with us to kick off the show. You think about where we stand right now. I mean, you take a look at the fundamentals underpinning corporate America right now. There's a lot of bullishness about where profits, where earnings could go. But again, then you take a look at what's going on the geopolitical front, all of these headlines being volleyed back and forth. And that seems very much to be what's top of mind for markets heading into the weekend.
Yeah, so, Katie, I think it's important that we frame this in the right way right now, because I think the way what markets are thinking is they're really thinking about it as a tipping point. So right now what we have is a price shock going through. Oil prices, equities are following oil prices. There's no question about that. That's a price shock, right? That is something that's going to degrade value, that's going to degrade prices, I should say. Because effectively what you're going to do is you're going to discount your future cash flows at a higher interest rates. As oil prices go up, interest rates go up, and you're going to get a lower present value. That's a very normal reaction. But that's a price shock. That's temporary. That's something that can go away over time. But the debate, though, is does this turn into a growth scare, or does this potentially increase recession risk? Then it becomes a valuation shock. So what we should really be debating is the difference between a price shock and a valuation shock. And I will say that right now, my view is that we are in a price shock, meaning that we have to adjust to higher oil prices. Look at interest rates. Interest rates are rising, and that's an issue. But today has showed me something very significant, and that today's the first time really that the curve is steepened in the way that 2-year yields have come down and 10-year rates have actually gone up. That is now the market starting to think that we could be tiptoeing into more of a valuation shock, which is something that would be a longer lasting downturn in prices. We're not there yet. That's not my case. That's not my view. But overall, that's, I think, what the debate is, and that's what the market's worried about.
Well, Jim, I was going to ask you, what is the nuance there, between price and valuation in terms of how you're thinking about a portfolio? You mentioned that you do see the curve steepening today. So that might suggest that we're heading into a valuation shock, at least from the market's point of view. It sounds like what you're saying, though, is that perhaps that's something you would fade at this moment.
At this moment, I would. And the reason is that we don't have enough information right now. We have to recognize that the initial conditions, the conditions that preceded this war, were actually relatively good. Strong, robust data, everything was going relatively well. And it's going to be hard to blow the U.S. economy off course or even the global economy off course, but it can be interrupted, which means that we could be into a period of assessing what the damage that's been done from oil shortages and higher prices that could set aside some of the good growth news. And ultimately, it's just going to take longer for it to really reignite. So I think we're in that waiting game at this point. We don't have clear information as to how long this is going to last, or even if it intensifies. So this is what the market's worried about. Look, it's a Friday. We're heading into the weekend. Saturday and Sunday, we're not trading, so people are nervous and they're taking down risk.
Glad you bring that up, because we've been here before. We've seen big policy pronouncements followed by the weekend. The markets aren't open, and I'm curious how that past is giving you sort of an indication of sort of how you might process anything that happens here, process the bad news that we've seemingly gotten today.
Yeah, I think we have to think somewhat technically on a Friday going into, a weekend, with these types of events, because ultimately, this is a question of, do we start to take risk off the table? Do you want to go into the weekend with any long positions on? And the answer is probably not, right? And I think then Mondays, what we typically see is a rebound, right? If nothing bad happens over the weekend, it's status quo, then people take back prices. So I think we have to look at today's downdraft in equity prices with a little bit of a grain of salt and just say that this is going to bounce around for a bit. But we're still waiting to hear if there's any improvements, because essentially what the market has to process is this whole concept of negotiated escalation. And this is what's happening, between the U.S. and Iran. It's a very common military tactic in these periods of time based on history, where you have a negotiation, but at the same time, you escalate the military force. So that way you think, both sides think they have a stronger seat at the negotiating table. That's a concept that's really hard for markets to process, because it just looks like things are intensifying and we're not making any improvements. But really, this escalation is being really thought of as the end game settlement, that you have to have this escalation before you get the actual negotiated, ceasefire.
Right.
And I think that's part of it.
All right, Jim, have to leave it there. Have a great weekend when you get there. That is Jim Caron. He is CIO of the Portfolio Solutions Group over at Morgan Stanley Investment Management. And coming up, a discussion with the mayor of one of the cities at the heart of America's ongoing affordability discussion. Los Angeles Mayor Karen Bass gives us her take and her proposed solutions next. This is The Close on Bloomberg.
City of Los Angeles is at the center of a national conversation about affordability. There is a housing shortage in LA and some of the highest gas prices in the country. Meanwhile, the city is getting ready to host the World Cup in June and the Olympics in 2028 as Hollywood braces for more job cuts because of AI and Paramount's takeover of Warner Brothers Discovery. Well, just last hour, we talked about the future of LA with its mayor, Karen Bass. Here's part of that conversation.
We are a city that loves our cars. However, we have spent the last 3 or 4 decades building out our public transportation system. And so encouraging people to use public transit, encouraging people to carpool. We certainly hope that this ends soon enough, because gas prices were already high here because we have chosen to tax ourselves to improve our environment. So adding on the international events and just the uncertainty from Washington, you can only imagine the concern that has when affordability is the #1 issue we're dealing with here, period.
Well, let me stick with affordability if I can. I know that permits for new construction have fallen every year since you took office back in 2022. Curious why that is. Also curious what you can do as mayor to reverse that trend in Los Angeles.
Well, absolutely. Number one is making it easier to build. And so I did that within my first couple of weeks in office. I signed an executive directive to fast track the building, especially of housing. And we have 40,000 units that are currently going through that process now, with several thousand actively under construction. But once we applied those lessons to affordable housing, then we began to apply those lessons in terms of cutting red tape to other types of building, whether it's commercial, residential, et cetera. And so that has helped. Now, of course, the other thing that is creating a lot of difficulty is just the larger macroeconomic issues.
Absolutely, and you're seeing that across the country. I do want to talk specifically, though, about Hollywood, about the filmmaking industry. We learned earlier this year that we saw the consolidation of Paramount and Warner Brothers, a hard-fought bidding war there on Paramount's part. The consensus is that this is likely going to lead to thousands of job cuts. You think about the unemployment rate in LA, it already stands at about 5.1%. That was at the end of 2025. That is higher than U.S. and state averages. So with this wave of job cuts seen as likely, what are you doing to prepare?
Well, let me just tell you, even before that, the entertainment industry is one of our foundation industries. And so I have certainly been doing everything to make sure that filming doesn't continue to leave and, in fact, increases in our city. And so the first thing, of course, was the advocacy on the tax credits on the state level, which did finally pass and get signed. I was involved when I was Speaker of the Assembly many years ago in creating the first tax credits. But I meet with the industry regularly, and they came up with a variety of things that the city could do to make filming easier. I put all of those into policy, put them into action, and we do have filming increasing in our city. Of course, I'm concerned about the merger. I think what a lot of people don't think about are all of the jobs that are associated either directly or indirectly with the industry, and making sure that filming can be easier. We have over 119 new projects that have started in LA since the tax credits and these other initiatives have been put into place.
You're preparing for two big sporting events. Let's start with the first. That's the World Cup. And I'm curious if you could describe the amount of investment you're having to make in security, and indeed who's going to be footing the bill for all of that.
Sure. Well, we certainly are anticipating reimbursement from the federal government. You know, we got the consideration for a national security event very early on, and so that unleashes a lot of support. But what we're doing as a city, the game actually takes place in an adjacent city, Inglewood, but we are preparing for tens of thousands, if not more, of visitors traveling throughout our city, and we're planning festivals and watch parties all throughout our city. We anticipate having 100 different events, and you know the World Cup lasts over 30 days, so we're really seeing it as an economic boom to our area.
It's a similar situation when you think about what's happening in New York, of course. The actual games are happening in New Jersey, but of course, New York City is going to sort of see the benefit of that. I do want to talk about the Olympics, of course. That is the other big sporting event. You have called for the ouster of Casey Wasserman as the LA 28 Olympic chair. You looked at his past ties to Jeffrey Epstein. He's staying put. So with that in mind, given that history, how do you anticipate working together now?
Well, we'll continue to work together. I'm in conversation regularly. LA 28 is the independent nonprofit that is putting on the games. It's located nearby City Hall. We collaborate on a daily basis. I set up an office of major events to handle all of the events. The culmination, of course, is the Olympics and the Paralympics. But we have the World Cup, the U.S. Open for golf for women. We have the Super Bowl. All of those things are happening before we get to the Olympics. And so we continue to work together. The decision whether Casey Wasserman stays was up to the board. They've made their decision. My role is to make sure that the city of Los Angeles is ready to welcome thousands, tens of thousands of visitors from around the world, and that all of the venues that take place in the city of LA are prepared.
I want to ask you for some comparison, if I could. So Dan Lurie in San Francisco has kind of shepherded that city from what was called a doom loop into a bit of a boom environment, thanks in part to AI. I'm curious how one mayor looks at another and the work that he or she does. Is there anything in his leadership that you admire or think might be transferable to your leadership of Los Angeles in this term, and if you're reelected to a second one?
Well, let me just tell you that one thing that has been very enjoyable about being mayor is that we are all in conversation and collaborate with each other and look at each other's experience. So actually, my view of San Francisco started with the former mayor, London Breed, who really focused on AI. She said she wanted it to be the AI capital of the world, and I see how he has continued that. And I'm sure he will expand it even further, looking at his ties in the business community. Now, you know, San Francisco is a much, much, much smaller city than Los Angeles is. We are so big, 500 square miles, that we don't have one big industry. I mean, the entertainment industry, of course, is our rock, but so are several other industries as well.
And our thanks again to LA Mayor Karen Bass. Now, coming up, the Nasdaq 100 dipping into correction territory as investor confidence falters in the face of the Iran war uncertainty and AI disruption. Bernstein's Stacy Rasgon, he joins us next to unpack the pressures on chips as their biggest big tech customers slide. This is The Close. Time now for our top calls to look at some of the big movers on the back of analyst recommendations. And first up, Halliburton. JP Morgan raising its price target on the oil field services company to $40 from $35 and sticking with its overweight rating. The firm expects less first quarter impact from the Iran war for Halliburton versus some of its peers in the space, calling its guidance conservative. Shares higher by nearly 4%. Next in line, we have Knight-Swift. Evercore ISI upgrading the stock to outperform from in line and boosting its price target to $65 from $61. The firm says that the trucking company is most poised to benefit from an upturn in the sector and one of the cheapest among its peers. Shares actually a little bit lower today. And finally, we have Adobe. William Blair downgrading the software company to market perform from outperform, saying that the competitive environment raises, quote, legitimate questions about its future. The firm notes a meaningful acceleration in organic growth and AI-driven share gains could turn things around, but in their view, that's unlikely in the near term. Shares lower by about 2.4%, and those are some of our top calls. Now that brings us to what we're seeing in the broader tech sector. The Nasdaq 100 slipping into correction territory as headwinds keep big tech in a pressure cooker. Memory chip stocks also rattled this week, and joining us live to unpack it all is Stacy Rasgon. He is senior analyst of U.S. semiconductors and semiconductor capital equipment over at Bernstein Research. So, Stacy, first of all, give us the lay of the land here, because just taking a look at the index level price action, it doesn't look good. Then I get into some of the specific names and sectors, and it looks even worse. So, in your view, what is going on here?
Yeah, I mean, look, there's a lot of concerns in the overall space around the macro and Iran and everything else, which is impacting everything. People have been worried about, you know, some of the semiconductor manufacturers in Asia, in Taiwan and Korea that rely a lot on Middle East energy. People were even worried about helium. It turns out a lot of that is made in Qatar. You mentioned the the memory stocks all taking a bath. There was a paper that came out, at least what they got attention, I should say, recently, that if you read it, suggested maybe less need for memory and AI, although if you dug in a little bit, what you realize is that paper actually came out a year ago. It wasn't anything new, but it was memory sort of had like a Mini-Deepseek moment, if you know what I mean by that, this week, and so it's pressured some of the stocks, yeah.
Yeah, I mean, you think about what we heard about TurboQuant, which is Google's algorithm.
TurboQuant.
Certainly sending a shudder through the chip stocks. And it's funny that you say maybe a little bit of a DeepSeek moment for memory. You think about the DeepSeek moment overall, that eventually was shaken off and faded. I know we're back in the hurt locker, but DeepSeek isn't exactly the reason why. So, I mean, can we extrapolate that out to some of these memory names, that this was just a blip and this is perhaps an overreaction?
Well, I mean, again, that TurboQuant paper actually came out. It was like in I think April of 2020, 5. So it's that news has been out for a while, and you got to remember, nothing that ever gets published in any of these papers is ever going to matter immediately to the companies that publish it. They wouldn't publish it otherwise. So, and people talk a lot about, like, what we saw with DeepSeek, was a little over a year ago, was everybody was very concerned that this new model was going to drop costs a lot. And we wouldn't need a lot of compute. And I mean, the only thing we've seen since then is compute demand skyrocketing. And people always refer to it, what's called the Jevons paradox, which is when things get cheap, people want more. And you have to remember, I'm a semiconductor guy, so of course I'm a believer in Jevons paradox. And semiconductors, cost cut in half every 2 years for 6 decades. Like it was a good thing for semis. It wasn't a bad thing. So in general, when I see these sorts of things, just overall, I tend to be more on the optimistic side. That was our take, on DeepSeek, in January of last year. That certainly played out pretty well.
Katie, a big believer in the paradox as well.
Big time.
I know that for sure. Stacy, let me ask you how we should be thinking about the Apple roll-off, and you throw some wonderful shade at the sell side here. You say they're astonishingly lazy mismodeling of the Apple roll-off. Explain how we should be thinking about it and what, in fact, the sell side got wrong on that, or is getting wrong.
Yeah, so this is for Qualcomm you're referring to.
Yes.
Yeah, so we actually downgraded the stock yesterday from outperform to market perform. And we've actually liked Qualcomm. I've been a fan of the content increases on the Android side. I've liked the diversification story and everything. There's a few issues going on there. One is the memory prices, because demand from AI is so strong, it's sucking up all the memory. And there are real shortages in areas like consumer electronics, like smartphones, who are having a real trouble getting the memory. And it's likely to significantly pressure a smartphone as well as other consumer electronic sales this year. And Seb was one reason I don't think the street numbers are low enough. And then you mentioned Apple. This has been a perennial problem in terms of the estimates. Apple is starting to do their own chips, and it is rolling out of the Qualcomm numbers. And the company has been 100% transparent about this, and we should know how to model it. But for whatever, and I think the buy side has been there, but the sell side, for whatever reason, it just hasn't been there. I mean, you can look at Qualcomm's numbers. The street has them growing revenues year over year in 27 versus 26. I don't know how that happens. I got like $4 billion in Apple revenue that has to go away. So street numbers have been too high, in my opinion, anyways, because of that.
Yep.
Now you sort of fold on, potential other headwinds from the memory issues. I kind of had to throw in the towel at this point. I kind of feel bad. I feel like Qualcomm is actually doing everything they can do, but the way I characterize it, they're just living in a bad neighborhood right now.
There you go, bad neighborhood.
Not a great place.
As you say, Stacy Rasgon, thank you very much. Senior analyst of U.S. Semiconductors and Semiconductor Capital Equipment at Bernstein. And coming up, it has been a wild week for energy markets. It looks like that volatility is not going to stop. We'll discuss what's coming up next with Amos Hochstein.
About 3:30 p.m. in New York. This is the countdown to the close. I'm Katie Greifeld.
And I'm David Gura. As we look at a correction in the Nasdaq 100, markets across the board down. And Katie, it seems like the war is still the animating factor in all of this, if I can use that verb.
Absolutely. I mean, we'll see what happens in the next 30 minutes, but it looks like we're going to close down on the S&P 500 for a 5th straight week. We haven't seen that since 2022, and there's been no bounce to speak of. You look at the S&P 500, David, I mean, we're pretty much at session lows here. At
session lows, and I continue to look at the VIX, which is higher than 30 now. That volatility, just a huge factor here, as we heard the guests over the course of the last 30 minutes. Looking for a sense of information on that duration variable in particular about this war, really getting conflicting messages, certainly from the administration, broadening that aperture, conflicting messages from across the Middle East as well.
Well, to that point, let's talk about the tail that is wagging all the dogs right now, and that is global energy prices. Brent back above $113 per barrel as President Trump's 10-day pause on strikes on Iran's energy infrastructure shows more uncertainty about what comes next and how long the conflict could last. Joining us live is Amos Hochstein. He is managing partner at TWG Global and former senior advisor and deputy assistant under President Biden. Fantastic to have you with us. You take a look at some of the ructions underway in oil prices, in Brent right now. Certainly getting back above $110 per barrel has caught the attention of a lot of people. But Amos, the question on everyone's mind is just how high could we actually go here?
Hey, Katie, it's good to be with you today. I know it's a tough day on the markets, but remarkably, I still believe the market is underpricing the current conditions. I said this a week ago or a few days ago on Monday when oil prices went down, I think WTI to 85 and Brent in the 90s. The disruption that we are going through today is the worst energy, not oil, energy disruption the world has ever seen. And I think what's happening is the market is doing two things. It's pricing risk because that's what the market knows how to do, right? So when Russia invades Ukraine, the market prices risk of losing 3 to 5 million barrels. I was in the White House at the time managing our energy situation. Today, we are not at a risk of losing millions of barrels. We have lost 12 million barrels a day. We've lost 20% of LNG. We've lost 5 million of barrels of products like jet fuel and diesel and gasoline. We've lost nitrogen and fertilizers. We have lost all kinds of other products like helium gases and others that come out of the region. And so as we now have to come to grips with this lasting much longer than the market thought, because this is the second thing that market's doing wrong. It is constantly choosing to believe that the conflict is almost over. So on Monday, euphoria, we'll have a deadline by Friday, we'll get a deal. Rumors of deals. There are no real negotiations going on at the moment. So we have to plan for this lasting longer. And this disruption is already affecting the global market. And if it affects one part of the world, it's going to affect everywhere, including here at home.
I want to ask you about the news out of the region today. That is that Israel is striking a power plant in Iran. So you have the president, as you mentioned, announcing this pause on the 10-day pause put in place there. And yet Israel is going after these power plants, going after that infrastructure. What does that say to you about the direction of this conflict and indeed Washington's grip on how it's proceeding, what is on the table, what's off the table, and sort of what's shaping those negotiations so much as they're happening, obviously through an intermediary in Pakistan, but not direct talks between these two sides?
So it's a good question because, number one, anything that the United States says that it is committing to has to have Israel abiding by it. It has to include Israel because otherwise, why would the other side take any notice of that? Right? So that's one very important point. The second is what it tells me is that we're really in managing markets, managing outcomes, not managing end result or end state. The president said at the beginning of the war, this will be 4 to 6 weeks. We've just concluded week 4. I think this continues for a couple of more weeks till we reach that week 6. But then there's no one's really have a plan for what happens then. Because the original goal, or one of the goals, at least the Israeli goal of regime change, seems to be off the table at the moment, not achievable. So the question becomes, what is the trigger that ends it? Especially since it's gone on long enough that the Iranians believe that they may be able to exact a price of their own to end the war, not succumb to diktats from the United States and Israel. So that means this could last significantly longer than the 2 weeks, unless the president sees that there is significant market dislocation and decides that maybe for a factor of reasons to declare victory and to try to bring it to a close. But I don't think that's happening any day soon.
Well, I want to talk a little bit about how this all plays out in markets. You made the good point that right now markets are pricing in risk. They're not pricing in disruption, and perhaps they should be. But in practical terms, what does that look like? If you see that shift to pricing in true disruption, how does that ripple across the energy markets?
So what happens is, look, when prices go up so much, the lowest income countries, economies, companies get hit first, right? So you have demand destruction. And we're seeing that has already started happening. That snowball has started. Sri Lanka has moved to a 4-day work week to conserve energy. The Philippines have announced an energy emergency with supplies running out within the next 40 days. Thailand, Vietnam, India. These countries are all reaching a point where it's not just that they don't have the money to buy it, they're actually having a hard time getting the product. There are no refineries in New Zealand. There are very few refineries in Australia and other places. So jet fuel starts becoming much, much more expensive. How does that ripple through? People stop traveling when it gets too expensive. Everything that we consume in the United States probably comes to us on a truck. So first it goes on a ship, and that fuel is very expensive. And then it goes on a truck, and diesel is now significantly over $5, nearing $5.50. That's very expensive, and companies can't hold that for long before passing it on to consumers. So that's how this starts rippling through. But it's even remember COVID. I think COVID is a good example here. Surgical gloves, the main manufacturer of the surgical gloves cannot get some of the most important materials out of the Gulf, and they're reducing their production almost entirely. So this starts rippling through, and I think that there's not enough of an understanding of how far along in that process we are already in.
Can I ask you a very quick question? We've seen the administration float all manner of things they could do policy-wise to try to bring down the price of oil, and they've been unsuccessful. Reinsurance, naval navigation through the Strait, et cetera. Is there anything, very quickly, we just have about a minute left, this administration could be doing that you think would make a notional difference in bringing down the price of oil at this point in the conflict?
I think they've lost the moment in time when they could have done that, which was before the Strait closed and preparation. The other thing I would advise them is not to give a new solution every other day, right? One day, as you just mentioned, releases, SPR, insurance. Right now, nothing can really change except for reopening, which can only happen with an end of the war. But cutting a deal with the Iranians of sparing energy assets in the Gulf and in Iran would go a long way to calming markets that the worst of the physical damage risk is behind us. And I think that hasn't happened. And today's attack by Israel and announcement by Iran, it should be concerning that we still have more to go on risk from more infrastructure to go out. I think that if I were the administration, I would focus on making sure the world knows, the market knows, there'll be no more damage to energy infrastructure. We're taking it out of the battlefield.
Amos, thank you very much for the time. A sobering conversation there with Amos Hochstein, managing partner at TWG Global, former senior advisor and deputy assistant to President Biden. Well, coming up, could Citi be looking at scooping up a major U.S. regional lender? Speculation is moving the stock on this Friday. It's today's stock of the hour. That is up next. This is The Close on Bloomberg. Back to The Close. Shares of Citi taking a leg lower as top executives there weighing buying another bank to ramp up deposits and fuel lending and trading operations. In a statement, Citigroup says the suggestion it is planning to buy a regional bank, wealth brokerage, or any other financial services firm is baseless speculation. Here with the details is Todd Gillespie of Bloomberg News. Parse that statement. Tell us what we have learned here at Bloomberg and dovetail that with the statement that we got from the bank.
Absolutely, David. Yeah, so what we know is that Citi's top executives have discussed internally within the bank about what they could do, right? I mean, we're talking about a bank that has been under the quash of regulators for years, is looking to get out of that. What could be the next stages in its growth story that it's now going to be pitching potentially to investors one day? We know now as well that the regional banking sector is facing major consolidation. There are a lot of banks who are, in the mix here, both as prey and as predators. And Citi is, having FOMO potentially, like a lot of the other big banks are right now. We also know that these conversations at Citi have reached a bar where they have raised the topic with regulators, which they have to do, crucially, because they're still under key regulatory penalties, which mean that they have to seek permission, essentially, before they were to make a major play. And we know that that was raised with regulators in a meeting earlier this year. And at the same time, executives have continued to discuss this topic internally. We know that it could be a super regional bank, potentially. We're talking some of the biggest regional banks that they could be angling for. Banks the size of potentially Truist, of PNC. Obviously, Citi's share price has done very well over the past year or so, but they're still looking at, a lower price to book ratio than any of their peers. Right. It could be a tough one to pull off, and we're still in the early stages.
Well, I'm glad you brought up, the fact that they did raise this topic with regulators. They're not planning it, but still, it's certainly a conversation that's being had. You mentioned that the regional banks potentially a target here. And when it comes to that space, I feel like we've been talking with the sell side for years now about that potential consolidation. It hasn't yet happened? I mean, what are the sort of necessary ingredients to sort of spur this into action, not just at the Citi level?
Yeah, I mean, for sure. I mean, Katie, on the regulatory level, right, we're talking about an administration now which is relatively, obviously, supportive of big deal making compared to previous administrations. But you're also looking at an administration that is somewhat still skeptical as well of the sort of horrors of Wall Street, the legacy of the financial crisis as well. Some of the big banks have also faced the ire of Trump for things like debanking as well. Citi itself, we know, has kind of flown under the radar when it comes to that so far. For instance, we reported that they're now banking Eric Trump and set up a trust with Donald Trump's money. We reported that last year. So, Citi is on, relatively speaking to some of its peers, it's on safer ground here. But there are a lot of a lot of factors that are contributing to an environment where a bank like Citi, even with the burdens that it's facing, probably doesn't want to miss out.
All right, Todd, great reporting. Citi shares down about 5% intraday. That is Todd Gillespie of Bloomberg News. Meanwhile, we're just 15 minutes away from those closing bells, and boy, what a wipeout when it comes to the S&P 500, when it comes to the Nasdaq 100. We're going to walk you through all the action coming up next with Dana D'Auria. She is Co-Chief Investment Officer and Group President over at Envestnet. This is The Close on Bloomberg.
Right now, my view is that we are in a price shock, meaning that we have to adjust to higher oil prices, look at interest rates. Interest rates are rising, and that's an issue.
That was Jim Caron, CIO of the Portfolio Solutions Group over at Morgan Stanley Investment Management, kicking off the show with us about an hour ago, David, and it's only gotten uglier out there since then. Yes,
since I presented this board to all of you at the top of the hour, markets continuing to fall to session lows. We see the S&P 500 there down 1.8%. Story here is it hasn't been this bad since 2022. Yeah, I believe. But again, this is a story that we've seen repeat itself now over the last few weeks. As we see the compounding factor, maybe the animating or the compounding factor of the roiling war in the Middle East. Yeah, absolutely. I mean, you think about the weekly streak that we've been cooking up of losses. 5 straight weeks, haven't seen that since 2022, as you mentioned, which was a very ugly year across asset classes, both with stocks and with bonds. And it looks like we're seeing a little bit of a repeat now, though it is early. Let's try to make sense of it all with Dana D'Auria. She is Co-Chief Investment Officer and Group President over at Envestnet. Dana, great to have you with us as we count down to the close here. So, I mean, you think about the pattern that's emerged over the past several weeks. Investors like to sell on Fridays, and intuitively, I guess that would make sense given that we get the bulk of these headlines over the weekend.
Yeah, well, I think the timing is intended to try to avoid, to a certain extent, problems in the market. But, at the end of the day, I mean, look, the market is used to looking past these kinds of events, these conflicts. There's an accustomed to having an expectation that, sort of the administration doing this is going to get in, going to get out, block any, real long-term pain. And so, the market, even the Fed will tend to look through, kind of quick shocks. I think what you're seeing now, and, therefore it doesn't react, right? What you're seeing now is a realization that we actually may be mired for some time. This is not something that's going to end, soon. It potentially could go on for a longer period of time than anyone suspected at first. And now you're starting to see that, market reaction and maybe even an overshoot to a certain extent to where we are today, which also is in line with, what is typical kind of when the market sort of has a recognition like this. Dana, count me among those who are kind of deeply sobered by what we heard from Amos Hochstein a few moments ago about where all of this is headed, and what he was getting into were the kind of second and third order effects across the market as a result of what we've seen in oil prices. How do you, as an investor, begin to think about that? So if it comes to a point where you and others can no longer see through this giant geopolitical risk, how do you start to think about the ways in which that'll affect companies that aren't just in the energy sector, but others as well? Yeah, I think that is the right question because, again, I'm sort of comparing and contrasting from where we started. Where you start is you expect an energy shock and not a ton of other permeation into other areas of the market. I think you have the exact right question here, which is, okay, now that this is not, an idiosyncratic risk in one part of the market, this is actually a risk that's systemic. It's going to permeate lots of parts of the market. Now the market has to try to price in what that impact is, obviously, and it crosses the board. I mean, we certainly see supply chains have already been disrupted, by tariff policy, by just the entire deglobalization trend that we've been seeing. Now you have another big supply chain shock. So I think, concern number one for investors, of course, is what does this do to the likelihood of the Fed cutting interest rates? We started the year with, 2, and we started in a position of strength, no less. We're now, unfortunately, in a position of a lot less strength. And we also have to worry more about inflation than anything else. And it's not like Fed cuts.
Well, exactly there. Where does that leave the Federal Reserve? Because you take a look at the pricing for the trajectory of Fed policy for the rest of the year. I mean, those rate cut bets have been evaporated. And I wonder, what that means for this market, because especially for areas like the small caps, for example, there were a lot of bull cases built upon that.
Yeah, you're absolutely right. I mean, look, we all know small caps, they're more interest rate sensitive. They were certainly catching a bid, and small caps had been doing quite well, as you know. We'll now have to see. They are more interest rate sensitive. It isn't likely. In fact, now, of course, you have concerns that the Fed may even raise rates. I tend to think that the Fed will, move slowly. This Fed has moved slowly. It hasn't been quick to react. We all know the transitory inflation debacle. I don't think this Fed wants to see inflation creep up. I think they're going to be more concerned about that than the cracks you're seeing in the labor market. We're not losing enough jobs yet for them to react on that. And so I don't think you're going to see rate cuts. The base case now, you're not going to see rate cuts this year. Obviously, that changes if we suddenly poof, we're out, which is not out of the realm of possibility, as we know. But, barring that, I think it's hard to imagine a rate cut. And then you're absolutely right. You have the interest rate sensitive sectors kind of taking more of a hit.
Katie, I don't know if you saw, but the president's signature is going to be on the dollar bill in the coming year.
I did see that, actually.
And Dana, I want to ask you just about dollar strength, because the Treasury Secretary, in announcing that yesterday, said it was a reason for doing that was because of the sustained dollar strength that we've seen. How are you thinking about that in the context of, yes, the war in the Middle East, but what we're seeing more broadly?
Yeah, I'm not of the mind, I never have been. We have been obviously seeing some dollar weakness for a while there. I had never been of the mind that the dollar sort of overnight is not a currency of choice, right? Or a place to kind of lay out for safety. I mean, yes, certainly at the margins, the world order is changing. And I don't say in any way to look at that as though it's not important. I just think it's slow. I think it's slow move. I think those impacts take time to kind of happen. So it doesn't surprise me to see there's some strength in the dollar right now. I don't think you're seeing a secular movement there, right? You're just seeing a result of what's going on in the market right now. I mean, look at gold, right? We're not now gold, which would be potentially a safe haven type of an instrument.
Right.
It doesn't yield, there's no yield on metal. So, you're seeing sort of short-term impacts right now. I don't think that's indicative of a long-term secular trend in any way.
Dana, we have less than a minute left here, but you touch on an area that I'm kind of obsessed with at the moment, and that is, where are the havens? We've heard some arguments for the dollar. Certainly that's performed. Gold, though, has not performed during this crisis. Neither has the bond market. So if you are looking for safety, where are you finding it right now?
Yeah, you're going to hate my unsexy answer, but I have to say it anyway. You have to be diversified. Otherwise, just get out of the markets altogether, right? I mean, volatility is a part of, what we all sign up for. And with, less than the minute, diversify, don't stay concentrated, and certainly don't start making individual, unless it's play money, don't start taking individual concentrated bets, because dispersion is high at a time like this.
All right, Dana, really appreciate your time on this Friday. That is Dana D'Auria. She is Co-Chief Investment Officer and Group President over at Envestnet. And again, you take a look at this market, no bounce, no meaningful bounce into the close, and who knows what this weekend holds. Actually, you'll be walking us through it.
I'll be walking you through it right here on Bloomberg Television, also on Bloomberg Radio, Bloomberg.com, Bloomberg This Weekend, tomorrow at 7 o'clock Wall Street time.
I can't thank
you like how easily
enough.
I did that, how readily that rolled off my tongue?
Pretty good. You can tell that you practiced that. In any case, the closing bell just a few minutes away. We'll take you there with the simulcast next.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
About 2 minutes away from the end of the trading day, Katie Greifeld and David Gura, and here to help take us through the closing bell, we have a global simulcast, joined now by Isabel Lee. She's in for Carol Masser and Tim Stanovic. We welcome in all of our different audiences across all the various platforms right now. And Tim, I mean, you take a look at the S&P 500. We're not going to finish quite at session lows, but pretty dang close, and boy, it was ugly out there today.
Yeah, just across assets, really ugly. I mean, I don't even know which superlatives to use. The Nasdaq 100 closing, or ideas it will close in correction territory. The S&P 500 right now trading at its lowest level going back to August 21st of 2025. Wow. So giving up all of the gains over the last few months, going back to this summer, Isabel.
What's interesting to me beyond these market moves are the notes that we're getting. We have Goldman Sachs trading desk saying that investors should not turn bearish on U.S. stocks. They're saying that current positioning leaves the market vulnerable to a short squeeze if, geopolitical tensions ease. So that's really an interesting take from Goldman.
Having a fascinating conversation here on the TV side just a few minutes ago with Amos Hochstein, talking about how the market is pricing in risk but not disruption. He telling us that we are actually in the middle of disruption and that those who've lived through this before are no longer trading, no longer active on Wall Street. But he very much making the point that this is a unique moment, a novel one, and one that's likely to have broader market implications, Katie, going forward.
Yeah, definitely a big note of warning there. You think that we've seen volatility in oil so far. If we do tip into pricing in disruption, as Amos told us we might be headed for, then certainly it'll be interesting to see the different cross-asset implications there. But we do hear the bells ringing on this Friday, the end of a trading week, and an ugly one at that. The S&P 500 down about 1.7%. That is going to cap off a fifth straight week of losses. That is the longest weekly losing streak since 2022. The Nasdaq down about 2.2%. I am loath to mention the Dow, but also finishing about 1.7% lower. That is going to help it enter into correction territory. The Nasdaq 100 there as well. And the small caps not escaping the selling either, down about 1.8%, Tim.
A relatively broad-based decline. If you look at the S&P 500, almost, David, 4 stocks lower for every 1 stock that is higher. 110 stocks did advance in the S&P today. 391 stocks moved lower, though. I
look at the IMAC function on the Bloomberg terminal, see what's in green, what's in red. Energy, obviously the one that's shining greenest, the most verdant there on my screen. Energy up 1.87%, as we've been talking about on both radio and television over the course of the day in these last few weeks. Oil prices really animating all of this, and that concern about how high they can go, and of course what that duration variable is going to be.
All right, well, there's a little bit of green in the S&P 500. I went to that part of the IMAP function and found some gainers today. The biggest gainer on a percentage basis in the S&P 500 is Entergy today, up more than 6.8%. This is a result of a deal with Meta Platforms. It's paying for the construction of 7 new natural gas-fired plants to fuel its data center in rural Louisiana. Meta reaching a new agreement with Entergy to build and pay for enough gas plants to provide a total of 5.2 gigawatts of electricity for the data center. The agreement includes a Meta commitment to help fund up to 2.5 gigawatts of new renewable resources, as well as a memorandum of understanding to explore future development and use of nuclear power. Entergy up by 6.8%, the best performer on a percentage basis in the S&P 500. Among the best performers in there as well, I think it was actually the second best performer. That's right. Brown-Forman up again on news of a potential acquisition by Bernard Richaud. So look at that. Brown-Forman, controlled by the Brown family, up 5.6% today. It was up yesterday as a result of this as well. The big question is the family going to approve, because they do have voting power of shares? And finally, Peloton. A blast from the past.
Yes, indeed.
Out there.
Speaking of 2022.
I was on my Peloton this morning. What are you talking about?
Katie has an impressive Peloton streak.
Okay.
Yeah, it's quite the setup.
All right. Well, I don't know how to segue that into what the stock did today, but it's up 8.9%. This is actually the result of Eric Jackson out there on social media. It surged as much as 17% before giving back some of those gains, surging the most intraday going back to July. Eric Jackson, the activist investor, said he is long the stock. Here's what he said, quote, "I'm long Peloton at $4, he said in a post on X. Peloton shares at that point were down about 24% year to date. Up right now, though, or up today to $4.43 a share.
Wow. now?
So for decliners, I was very spoiled. I had a lot to choose from. We can start with Amazon. It's down by 4%. No specific news, but we do have the European Commission saying it was hit by a cyber attack that may have resulted in the theft of internal data. And the attack struck the Commission's Amazon Web Services, or AWS, account, so before being detected. So maybe that had something to do in part with the stock's decline. Up next is Coinbase. I wanted to talk about this because I wrote about this story yesterday about how Coinbase is teaming up with Better to really offer crypto mortgage. Tim will be interested in this too, crypto mortgage to Americans. And now we have TD Cowen saying that the product is mixed, so that's not really that great. The advantage for the borrower is that they can obtain credit against Bitcoin holdings, the TD Cowen said, but it's still questionable how they will move forward with that. So we have Coinbase down by more than 7%. And lastly, we have cybersecurity stocks down, but I want to zero in on the ticker PANW. That's Palo Alto. Shares are in the red by 6%. It's joined by its peers CrowdStrike and Saylor, dropped by almost double digits. So it's really because of a Fortune report about an artificial intelligence model being tested may be used by hackers.
All right, let's take a quick look at the bond market there because also spoiled for choice, though you did see an interesting steepening, which we were talking about with Jim Caron. You can see the 2-year yields actually fell 8 basis points, a little bit of a rally in the short end of the curve, which was certainly interesting when you think about where we were after that ugly auction earlier in the week. Can't say the same for the rest of the curve, though. You saw a little bit of selling pressure deeper as you get further out the curve. 30-year yields higher by about 4 basis points. 10-year yields, we are back above 440. Tim, are you scared?
I wouldn't say I'm scared.
Okay.
But what I will say is I wonder what the president's next move is, because yesterday after the sell-off, what we saw was a message from the president calling for an extension, and by many accounts, perhaps a third sort of extension. And the idea was that maybe this would give more time for negotiations, and markets bought it a little bit. But then this morning, with a seemingly increase in hostilities overnight and more strikes and strikes on infrastructure as well, markets are not buying the idea that there is a sort of an off-ramp anytime soon. I mean, look no further than oil prices. You have Brent right now up above $113 a barrel, WTI hitting $100 a barrel. That's up close to 6% right now, and Brent up, Isabel, what? Almost 5% today.
It's really been wild in the oil market, but I'm wondering if we're a victim of our own quant system, algo system, or just our own fear. Citi released a note this week saying that selling off on Friday and buying back on Monday has been a recurring pattern over the past few weeks because investors are just really wary of carrying risk over the weekend because maybe they want to have a nice brunch session or hang out with their kids, but they buy the dip.
Bloomberg
Thank you so much, Katie. I appreciate that. Yes.
I feel like that's really maybe something we're seeing. Citi also said conviction has been low because, of course, it's a headline-driven market, and it's really been tough to figure out this narrative.
Picking up on that, I wonder how inured we're getting to this, the way that all of this has unfolded. And Tim, I think your point is a very good one. What does the president say we're due next? We have this very specific 10-day extension ending at 8 p.m. East Coast time, which I think is 3:30 a.m. Tehran time on April the 6th. I just wonder sort of what power he has in this moment. I think that's what's been laid bare today as we've seen Israel make those strikes on infrastructure in Iran today. I think the president feels like he's still calling the shots and running the show and determining how long this is going to last. But I will say from what I've watched over the last few weeks, he seems to have limited power in that regard there, especially as this war widens, Katie.
And I'm sure you're going to be discussing something along these lines at 7 a.m. tomorrow and on Sunday. But it is interesting. I mean, you think about the potential end games for Israel. You think about the potential end game for the U.S. How much of a gulf is there between them? That certainly is a big question as this Iran war continues to deepen in terms of the time frame. It's going to be interesting to see how all of this plays out in the market. I keep going back to this note from J.P. Morgan, basically saying that should oil trade at $110 per barrel for the rest of the year, that earnings estimates for S&P 500 companies would be shed by as much as about 5%. And that really is one of the last sort of rallying cries of the bulls out there, that corporate America still looks pretty good right now, Tim.
So that could be the view on what happens to earnings, but there's also a big political element to this. We had a great conversation with Joel Lovinger out of our Texas bureau earlier. He, along with Jeff Mason out of DC, went to CPAC over the weekend, and what they heard from people was a real difference in sort of their support for the president because of this war. But it reminds us that affordability is what this president ran on. And if oil stays high and affordability, things don't become more affordable for Americans, I think, Republicans really could pay the price at the polls come November. But before that is Bloomberg This Weekend. 7 a.m. tomorrow.
Thank you so much.
David Gura will be there along with Christina Ruffini.
And hopefully watching.
Yeah.
Comfort of the Peloton setup, whatever.
I will definitely be watching. I'll definitely
hop on your Peloton, put on
in.
Bloomberg This Weekend. It sounds like a great Saturday.
It does. It is going to be a great Saturday. David, we'll see you tomorrow.
Thank you.
Katie, we will see you on Monday, same time, same place. That is going to do it for our cross-platform coverage of the close. It is the closing bell every day at the close. Have a great weekend. We'll see you guys on Monday.
All right, coming up, the Nasdaq entering correction territory with the S&P 500 now finishing lower every single Friday in the month of March. We'll wrap up all the market action in today's Factor Friday. This is the close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is the close.
Welcome back to the close. I'm Katie Greifeld. Let's take a look at where markets closed out on this Friday, heading in to yet another weekend where we're watching for the headlines. The S&P 500 down about 1.7%. On the week, it'll finish about 2% lower. That is a fifth straight week of losses. Even worse when you take a look at the big tech names in the Nasdaq 100, that benchmark finishing down about 1.9%. The bond market relatively well behaved today, only higher by about 2 basis points when it comes to your 10-year yield. A little bit of a rally in the short end, but the VIX, as you can see, a lot of volatility coming back into this equity market. The VIX going to finish above 31. Let's dig into what we saw on the equity side and the individual movers. ExxonMobil was one of your top gainers in the S&P 500 today. Energy stocks, a rare bright spot in a sea of red. Exxon higher by about 3.4% on this Friday. Coca-Cola, too, no specific headlines, but higher by about 1.4%. And there was a lot of pain, as I mentioned, when it comes to big tech, when it comes to your big chip makers. NVIDIA down about 2.2%. But it's time now for our weekly ETF wrap, really my favorite part of the week. And we're talking about the State Street Spider Portfolio S&P 500 ETF. This is basically a version of their bigger fund SPY, but it only costs 2 basis points. They cut their fee to 2 basis points in August of 2023. And as you can see on the chart in front of me, assets in this fund have absolutely skyrocketed since then. So let's discuss it now with Eric Balchunas of Bloomberg Intelligence. You pointed this out in a recent research report, and I think it's fascinating because you think about the way that the industry has been going. You're seeing ETFs become more expensive at launch because we've had this move into active, into derivatives-backed funds. But this example pretty much shows that costs still matter to investors.
100%, especially in areas that are, quote, vanilla, right? If you're looking for cheap beta or something to track an index, investors are very cost obsessed. They will literally screen for the cheapest one and buy it. And SPYM is a great example of this. 1 basis point cheaper, that's it. So it's interesting also, the makeover of SPYM, and again, I've never seen a makeover this dramatic. It went to 2 basis points, but 2 years before that, it stopped tracking a Morningstar index and started tracking the S&P 500. So if this had kept with the Morningstar and been 2 bips, nobody would really care that much. It's the S&P 500 combined with the 2 basis points that is utterly irresistible. And that is why it is climbing the charts very quickly and is actually, in my opinion, a threat to IVV and VU, which it came out of nowhere. It almost feels like it's been sent by State Street to avenge the dethroning of SPY by VU last year.
Yeah, I mean, first off, you mentioned the makeover. We should also mention that this ETF also recently changed its ticker. It was SPLG. Now it's SPYM, so more closely aligning itself with SPY, to your point. And let's talk a little bit more about the flows because, you know, the ETF flows, Eric knows this better than anyone, but they move around a lot. But at least for this moment in time, SPYM has taken in more than any other ETF year to date in 2026. And Eric, that includes IVV and that includes VU.
Yeah, and IVV's seen outflows, so is SPY. Now, to be fair, SPYM has taken in about as much as SPY has lost. But the fact that it's even like within like earshot of VU, let alone above it, is crazy. I have, we do this show every week. Have you ever not seen VU at the top? I haven't. It's just like it lives there. So for SPYM to be up there in that sort of area is really interesting to me. And I know this is boring, right? It's the S&P 500. We get it, But in terms of like the stakes here, it's State Street versus BlackRock versus Vanguard. And these ETFs are really the future of finance. They have so much money. They're very liquid. And they are what a lot of the industry revolves around. So when they have a battle, the stakes involved are massive, even if, they're pretty familiar to people. And I know we talk about active and hot sauce, but at the end of the day, people are still really into cheap beta. I mean, it really kind of is the trade still.
Well, people like vanilla, it's the best flavor out there, in my unbiased opinion. Eric, great to talk to you. Have a great weekend. I'll see you on Monday. That is Eric Balchunas of Bloomberg Intelligence. We anchor ETF IQ every Monday at 12 noon. But if you need a fix before them, and I don't blame you if you do, you can subscribe to my newsletter, also called ETF IQ. That is Bloomberg.com/ETF IQ newsletter. But let's go from one BI expert to another and bring in Chris Kane for another edition of Factor Friday, breaking down the different factors to watch. And Chris, first off, let's get an update here when it comes to the different equity factors, how they've worked so far in a very volatile year.
Yeah, I'm very surprised, Katie. I just would not have thought the factor moves would be what they are. So basically, value and momentum are the leaders in 2026 so far, both up double digits. It's a bit surprising to me, especially value, considering that value is a pretty pro-cyclical factor. So when things bad happen in the world, there's a geopolitical event, typically, value is kind of thrown out with the bathwater. We haven't seen that at all. And conversely, we haven't seen a rally in the defensive factors. Like, again, you would think you would see when there's a war with Iran. We don't see things like low volatility factor working, profitability factor working. So I know we do see some, volatility on the index level, but internally, I just don't see much of a defensive factor rotation. And, that remains to be true.
Yeah, it is interesting to see that value really has held up, to your point. But let's talk about the benchmark overall, the S&P 500. At this point, it's well below its 200-day moving average. Where does that tell us about where we could be headed next?
Yeah, so, everyone watches the 200-day moving average, right? It's really a benchmark kind of line in the sand for market participants. We did a big study about the behavior of the market above and below. It's not really about returns. When you look at the returns above and below the moving average, it's very similar. The stark difference is in volatility. So you see much higher volatility when the index is below its 200-day moving average. Just to put some numbers on it, annualized volatility of 13% above versus 29% below. And the volatility works both ways, right? You see the biggest gains and the biggest losses when we're below the moving average. So basically, it's a more unstable picture. It's not necessarily bearish. It's just we should expect more wild swings now that we're below the 200-day moving average.
Yeah, absolutely. Chris Kane of Bloomberg Intelligence, really appreciate the insight, especially when it comes to the technicals really coming into focus. And to that point, the Nasdaq 100 officially sliding into correction territory. Kim Forrest, she is Chief Investment Officer over at Bokeh Capital Partners. She joins us next. This is The Close on Bloomberg. Well, the Nasdaq 100 sinking into correction territory, down 10% from its peak all the way back in October. Now, the sell-off comes as the war in Iran rattles investor confidence and big tech companies face skepticism around AI spending. Kim Forrest, she is founder and chief investment officer over at Bokeh Capital Partners, joins us now. So, Kim, let's start right there. I mean, the Nasdaq 100 officially in a correction. I wonder at this point, do you think we might see some of the dip buyers come in, or some of these different headwinds something a little bit more substantial when it comes to your big tech cohort?
Well, I think two things are happening here. I'm sure we've just talked the whole Meta thing to death. It's in the Magnificent Seven. It has lawsuit problems. And, that certainly is not helping out NASDAQ, right? But let's talk about AI. And I think AI is a disruptor, and it is disrupting software companies for sure. I think our biggest thing that it's disrupting right now is Microsoft, who on the way up, it was driven by AI, and it was driven by its association and funding of OpenAI. And now it looks like, well, maybe Anthropic is the winner of AI today. And Microsoft doesn't have a whole lot of, I mean, they have some, involvement with that company, but certainly not like it did with OpenAI. So I think that most of the tech investors are trying to figure out what AI is going to do to the tech sector, and more importantly, withdrawing money from software and seeing where the wreckage lays.
Yeah, it's a fascinating turning of the tables, because it feels like for the past several years it was, okay, we know that AI is going to disrupt almost every sector. Let's see this wrecking ball go through all of them. And now, of course, it's turned back and we're talking about the tech sector itself. I'm glad you brought up Microsoft, because it's heading for its worst quarter since 2008, Kim. And it sort of begs the question, the leaders that we talk about today, the Magnificent Seven, the household names that we all know, are they going to be the leaders 5-10 years from now?
That seems like maybe an age, like the 5 years is like, I don't know, what are the dinosaur ages, like the Pliocene or something like that? I think that's way too long to talk about. But that being said, so here's my thesis on Microsoft. Businesses use it. We're not really migrating over to Microsoft. I sincerely doubt that AI is going to be able to whip up, really quickly something that is an Excel killer. And yes, we still need Excel, even though we're going to ask AI some questions. I think people will always have to look at their data and touch and feel and move it around, not just have, verbally speaking to a computer or typing a few lines in and saying, analyze this. It just doesn't work that way, in the sciences and in business with money. So I think Microsoft is one of the, I don't want to even say surer bets, but, I think they're going to hang out here. I also think it's really ironic. Tech people always get it wrong. Way back in the dark ages, whenever it was Linux coming up, they thought Microsoft was going to get killed by it. And instead, all of the Unix vendors, and that was Sun Microsystems, remember them? IBM, and I can't remember the third one. HP, there we go.
Right.
They got killed by Linux. Uh-oh. So, tech doesn't even know where things are going ever. And I like that. I like it as an investor.
Well, talk to us a little bit about that. I mean, amid all the volatility that we're seeing right now, the babies, the bathwater, et cetera, I mean, where do you see the biggest opportunity right now and potentially the biggest bargains?
Sure. Well, I think I like the data repositories, that it's going to be really tough to wean yourself off. So that would be things like Microsoft, where most of business has kept its information in a Microsoft product. And yeah, even that database that we call email, it's very important, and they kind of rule the roost at this point. And I don't know that that's going to change with or without AI. So somebody else might be someone like CRM, where yes, a company can use AI to better write a message to their intended clients, but all of that data that's being stored, and it's years or maybe decades now, of data that's stored about how people have purchased your products and who they are and all that kind of good stuff, it's residing there.
Right.
Probably the ones that I have a great amount of doubt about are people that were just kind of adding value around the edges, kind of writing scripts or doing non-essential work. And you really have to look at each and every offering about how much value is this product giving to its clients. And that's how you decide of whether or not you want to invest in it.
All right, Kim, got to leave it there. Great to get some time with you on this Friday afternoon after a very volatile week. That is Kim Forrest. She is founder and chief investment officer over at Bokeh. Capital Partners. And you think about the week that was with the Nasdaq 100 entering correction territory, the S&P 500 not too far behind. What will be the next catalyst? Have to imagine that it might come, of course, from the oil markets, and a lot of that comes down to what's going to transpire over the next weekend and the weeks to come. But coming up, we're going to focus in on the private markets, actually, because private credit fund managers navigating heightened pressure from investors with $5 billion locked up in investment vehicles. We'll break it all down with Michael Anderson. He is head of global credit strategy over at Citi, about what's at stake. That conversation up next. This is The Close on Bloomberg. Oaktree saying it will meet all redemption requests in full for a $7.7 billion private credit fund aimed at retail investors. The firm saying it has been mindful of the need to preserve liquidity, setting itself apart from some of its peers that have capped withdrawals. Joining us live is Michael Anderson. He is global head of credit strategy over at Citigroup. Michael, great to have you with us. So it's interesting, I mean, how these different managers are, handling withdrawals, some capping at 5%, some trying to go a little bit more than that. But the point remains that they're getting a lot of withdrawal requests right here. And I wonder, in your view, how much of this is just human psychology, a sort of feedback loop, all these different headlines versus, something is maybe seriously wrong with these portfolios?
And you'd have to imagine a good bunch of this is going to be sentiment driven. If you look at, even though these private credit markets have limited transparency, there are public signals that we can gauge what sentiment feels like. And with BDC equities trading about 20% below the NAV and wide dispersion around that as well, BDC corporate bonds trading to wider spreads than they did at the depths of Liberation Day, it seems like it's very natural to see these sort of redemptions, just given that you could redeem at NAV, whereas the other marks in the public market are telling you that that's not the case. And as far as the 5% gates, managers are trying to balance the interests of investors that are looking for liquidity. So they want to meet that 5% commitment that they made. Some managers have gone above 5%, maybe the parent or the management team employees have chipped in to go above that. But ultimately, that's just one part of the equation. The other part of the equation is you got to make sure that the investors that are left in the portfolio are not disadvantaged by having a lower quality portfolio left.
Well, Michael, that's exactly where I wanted to go because, you recently spoke to some of my colleagues over at Bloomberg News and gave this quote that you have the remaining investors and those trying to access liquidity, and managers have to balance the needs of both constituents. If you start meeting redemptions that are too large, what does the surviving portfolio start to look like? And I find that really interesting because let's say you are capping withdrawals at 5% for this quarter, but you continue to get that. What does that mean for the surviving portfolio? Because I have to imagine that, you're selling the more liquid and thus high quality assets off first.
Yeah, I mean, so these are quarterly redemptions, and 3 months, as we know, is a lifetime in markets. So we'll see what happens in 3 months. But I think you raise a good question, and that is if you get these repeated 5% redemptions, and if maybe you're meeting a larger redemption. Because one thing about the loan market is that they're without any call protection, and a lot of these are sponsor-backed companies. And so these sponsors are buying and selling. They may be going to other markets. So there always is some level of turnover. There's always some level of loans getting paid back. But if the loans that are getting paid back are probably higher quality loans. So there is a bit of a negative survivorship bias in terms of what loans have alternative sources, whether it's another company buying that company or maybe going into another market. So yeah, it's definitely a very big consideration.
And I do wonder, what this episode means for future fundraising, because, I mean, maybe this all blows over, but, the point has been raised that just this episode alone, the experience of being gated and, maybe these self-directed individual type investors experiencing that for the first time, it could dampen enthusiasm for retail investors to come into these products into the future. If you have a situation where you are getting these withdrawals, I mean, the question is out there, are they going to get enough inflows to sort of offset that and balance it out?
Yeah, I mean, well, to date, they some of the managers are boasting of strong institutional inflows, but the retail side could be a little bit once bitten, twice shy. You have, you're always looking for mismatches in our market, whether it's liquidity mismatch or credit mismatch. And number one, these very large redemptions tell you that there probably was a little bit of a liquidity mismatch in terms of what investors expected liquidity provisions to be. But also on the credit side, I mean, these were loans, secured loans, first lien loans generally, and you usually feel pretty good if those loans start to experience some stress. But if you're dealing with a secular issue or a potential secular issue like software, well, then you start to question, well, what are my recoveries really like? Are they going to be similar to, say, a cyclical company that stubs its toe and has to restructure? The secular story can be a lot more of a challenge for the lenders and then for the investors. So I think it's a really good point that maybe this will help correct those mismatches in liquidity and credit expectations.
And I want to hear your thoughts on, what this could mean for the rest of the fixed income world. The point has been raised. I was speaking with Boaz Weinstein of Saba on the Money Stuff podcast a couple of weeks ago, and his view is that what you're seeing unfold in private credit, that this is going to bleed into other parts of the market, including on the public fixed income side. And I wonder if you share that sentiment over at Citi.
Yeah, I mean, there's definitely some transmission mechanisms from private credit to broader public markets. I mean, number one, you could have people, if they can't get their money, investors can't get their money on the private side, they may sell public. If the private markets take a step back, I mean, we may get a lot more supply. Overall, we think that the transmission mechanism to the financial system is fairly limited, but there's definitely the potential for knock-on effects through other avenues.
All right, Michael, really great to get some time with you. Appreciate your insight on this Friday afternoon. That is Michael Anderson. He is Global Head of Credit Strategy over at Citigroup. Meanwhile, let's take a look at where markets closed on this Friday. You already know it did not look good. The S&P 500 down about 1.7%. A lot of that pain coming through in the technology stocks, as evidenced by the Nasdaq 100 finishing about 1.9% lower, officially entering that correction territory, down about 10% from its October peak. The bond market relatively well behaved, but the VIX closing above 30 for the first time since April. This is the close on Bloomberg. Traders bracing for a longer war, oil rising as the U.S. and Israel strike nuclear targets while Iran hits back across the Persian Gulf. This is the administration signals to allies it has no immediate plan for a ground invasion, according to people familiar with the matter. Let's break it all down with Sarah Bianchi. She is Chief Strategist of International Political Affairs and Public Policy over at Evercore ISI. Sarah, great to have you with me here. So you think about what has transpired over the past week, the U.S. sending that 15-point plan to Iran, Iran rejecting that, coming back with its own 5-point proposal. It seems like, the two sides here, there is great distance between them. And I wonder what you think a potential off-ramp might look like.
Well, I think there is not really a very near-term off-ramp. I think the challenge for President Trump is that the Iranian regime has, proven, tougher and more willing to fight than I think may have been anticipated. And so I don't think there is a place to go right now. And so both sides are going to have to decide what they're going to do to get there. That obviously is very risky, which the markets are not liking. I think, the markets like certainty, and this is anything but. And so at this point, I think it might have to get worse before it gets better.
Well, let's talk about what getting worse might look like in terms of potential escalation here, because I do think it's interesting that the president, in talking about the decision to sort of pause those strikes until April 6th, also gives the U.S. time to amass more forces in the region. I mean, that's not necessarily the words of someone who is looking to de-escalate fully here, or at least that might suggest that escalation is sort of in the offing.
Yeah, I think the challenge for the president is that, and is that he always was hoping to be able to find a moment to sort of call mission accomplished, to say we got rid of the Ayatollah, we've made so much destruction. Obviously, we're all heartened to see yet again how well the United States military has performed. But with the situation in the Straits being closed, I think even President Trump has a hard time saying that it looks anything like success. And so I think they're going to have to keep going until they can figure out an off-ramp that includes that at a minimum as a component, irrespective of any other points that may or may not be agreed to. And so I do think we are looking at the potential for escalation, maybe even ground troops again, because it's hard to have a pause with where things are right now.
And you mentioned, of course, the Strait, and you think about that 5-point proposal that was sent over by Iran, and it included sovereignty over the Strait of Hormuz. And I wonder, if that's something that would ever be politically palatable to the U.S. and to Israel.
I think it's very difficult to imagine that scenario for either country, not to mention others in the region. And so I think, certainly it's just hard to imagine a scenario where that's going to be comfortable. And of course, the industry is rightly watching what's the Navy willing to do? What kind of risk are they willing to take? And until there's a scenario where there's comfort around that, I don't think that's a stabilizing proposal. But look, there's a lot on each of those plans that certainly is a initial proposal at best. And so I think we have a long way to go till we have something that looks like an agreement.
And Sarah, from where you're sitting, I'm curious what you make of sort of the relationship here between the U.S. and Israel, because, I mean, you think about the different potential end games here, the U.S., what the U.S. has in mind versus Israel, which sort of started this campaign with regime change as a stated intention. Do you sense a potential gulf here when you think about these two sides being united against Iran?
They certainly have very different end goals in mind, and that's always been the case. I think potentially if we could get to a place where Iran and the United States are willing to kind of agree on some points, I think there is potential that Israel would come along. I think they have gotten more done with this president than any other. They've had a lot of successes. I think the challenge right now and why the bid ask is so wide is because of the Iranian regime, the RGC are very intent, and there's just a kind of an imbalance. I mean, if it can attack any one of these ships, or then it's just not safe to do business. So I think the larger challenge is trying to find an alignment with Iran. Israel is certainly challenging as well, but I think that's secondary at this point.
And we're actually hearing from President Trump speaking in Miami now, saying on Iran that they are being decimated. They are talking now. Also, President Trump reiterating that Iran wants to make a deal. But Sarah, I do want to turn our focus more inwards here and talk a little bit about what is going on with Congress, especially as it comes to TSA funding, a potential deal here in the Senate. Looks like it's hitting a little bit of pushback in the House. And you have to wonder at this point, the shutdown, the squabbles over funding, what we're seeing at the airports, is it more politically toxic to the Democrats, to the Republicans, or both?
Well, as soon as one side or the other decides that it is more toxic for them, then you'll see a deal quite quickly. I think the challenge has been right now, both sides, I think this is playing okay. I just came back from the airport. I will say it's not going to work that well for people who are traveling, particularly on the coming Easter weekend. But I would say, look, I think the problem is right now, Speaker Johnson needs Democrats to get the deal that passed in the Senate, and he's going to alienate his caucus if he goes that route. So he's a little bit stuck. So I don't believe that we have a near-term resolution. But again, at some point, these polls are going to show they're hitting one side more than the other. We haven't really seen that yet. When we do, I think we'll find a way to break the logjam.
All right, Sarah, really appreciate your time on this Friday afternoon. That is Sarah Bianchi. She is Chief Strategist of International Political Affairs and Public Policy over at Evercore ISI. Now, still ahead, what investors need to watch out for over the week ahead. This is The Close on Bloomberg. The end of DEI in America. That's at least what President Trump touted in last month's State of the Union address. Our very own Romaine Bostick got the chance to speak with 5 prominent Black executives for a candid conversation on navigating this administration and the current mood across America. Here's part of that conversation.
So we're sitting around this table. We all kind of look the same. We're all Black. First of all, we should have some white guys having this conversation, right? I always say this because it's almost like the victims have to defend themselves and explain why we're being victimized, right? We have to kind of explain what other people are doing to us. The way I think about this is times 100 years ago were worse than they are today. They're better today than they were 100 years ago.
No doubt. Absolutely.
And people didn't like it 100 years ago. They don't like it today.
Yeah.
Right now, we have a big problem because the guy who doesn't like it runs the damn place, right?
That's the big difference.
That's a huge difference. So I say to all of the people, Black, white, male, female, watch it and make sure that the rules that we all want to live by, the democratic rules, the rule of law, the rules of a democracy, work for me, even though you don't like me, or even though I don't look like you. It has to work for me if it's going to work for you too.
Well, I think that's the myth of DEI, that we were the only people that benefited.
That's right, benefited from it.
And then you know all the stats in terms of representation and who rose also with civil rights.
Women benefited so significantly
it's just
from
like,
this.
exactly. So I don't even feel like it's a victim's narrative. I feel like it's a survivor's narrative, that we are sitting here talking about how we have survived and will continue to survive. And I don't mind that, because there's someone out there who maybe doesn't have a voice, who doesn't feel like they can speak up. And I know those people who are like, I am literally just going to tough it out in this moment. I was one of those people. I'm not even sure what I'm doing here now. I also thought about, you know, who do I want to be in this moment? Yeah? How do I want to show up and be in this moment? And it's scary for some people.
It's scary, but the truth of the matter is, those of us around this table, we don't
No
really
choice.
have anything to fear.
Thank you.
Right? We've had
We have no choice.
storybook careers. We've amassed more wealth than we probably ever imagined. We've impacted our families, our communities, our colleges. We are, for the most part of the protected class.
We are the
right?
them.
But if we don't stand up and speak out, the situation could get worse.
Will get
Right.
worse.
It will
Right.
get worse. And so those of us at this table, I know, think about kind of the issue of impact. The question is, beyond the conversation, how do we actually generate more impact?
Do you do that quietly? Do you do that out loud?
To answer that question, I think one of the benefits of the last few years is that we now have data. To your point, like, we know this is not a charitable, endeavor to create diversity. We know that 87% of teams make better choices if they're diverse. We understand that 17, 20% more revenue, particularly from innovation. And so I think for us, our job is to remind people this is a data-driven assignment now for corporate America, and frankly for the federal government too.
There were some corporations that had that proof. I mean, let's just take the retail side.
Right.
You talk about Target opening up its shelves to hundreds of Black businesses. The impact was tangible. Anybody can go, you can look at their quarterly reports. It was tangible. But once Stephen Miller and some of the other folks started coming for them because of their stance, and not just for black entrepreneurs, but what they did for LGBTQ and other folks as well, I mean, let's just be honest about it. They caved.
There are so many companies, individuals, institutions that have in fact been very supportive of us within our community. And I think it's in our interest to help provide them with support to continue to understand we're here, here's what we can do. Let us also show you why and how it benefits you. And then they'll be able to at least have the data, the information that's necessary to continue to try to support. But there's no doubt the cooling effect.
I think we're looking for rationality. Data will not make a human rational, right? And I think this is a lot of what we're seeing, you know, in the face of very good data, in the face of history, in the face of just common sense, you know, capitalism. This doesn't make any sense. And so I think.
What about money, though? What about, you know, increase
Yeah, but the short-term money,
Yeah.
money is not big for these guys at all.
Right.
I mean,
but what about
all you got to do
long-term?
is survive a couple of quarters. Right? This is a lot of thought. By the way, rightfully, that's right. Rightfully so. I mean, I don't want them all to kind of run into the breach and get shot down as in their way, and they have to be longer planners. And so I don't actually blame Target as much for their short-term actions as I would blame them for not rolling it back the other direction if they don't do that.
That was our very own Romaine Bostick in conversation with some of the most prominent black business leaders on the state of DEI. You can catch more from that discussion tonight at 8 p.m. Eastern, right here on Bloomberg. Let's take a quick look ahead to what we're watching over the coming week. A holiday-shortened week, to be sure, but as you can see from that calendar, it is action-packed. On Monday, we're going to hear from Fed Chair Jerome Powell. Also, the U.S. Senate recess is scheduled to begin. That brings us to Tuesday, and we kick off with earnings from Nike, a stock in need of some good news. Shares down about 19% year to date. We'll also get U.S. consumer confidence as well as Eurozone inflation data set to be released as well. And on Wednesday, more economic data from the U.S., more on the state of the consumer in the form of U.S. retail sales data. And then Thursday, it's all about the labor market, the U.S. jobless claims coming through, as well as challenger job cuts. And that brings us to Friday. Markets officially closed for the weekend holiday, but we have one big data point that is set to be released. That is the U.S. jobs report, a crucial piece of the puzzle for the Federal Reserve trying to make policy in the midst of a still unfolding war. But that does it for us for now. Balance of Power is up next. Have a great weekend. This is Bloomberg.